What is the impossible trinity? 4 fixed exchange rates. Imagine trying to balance 3 different goals in international economics. You want a fixed exchange rate, free movement of money across borders, and the ability to control your own interest rates. But here is the catch. You cannot have all 3 at the same time. This is what economists call the impossible trinity, or the policy trilemma. Let's break it down. First, a fixed exchange rate means you peg your currency's value to another currency or a group of currencies. This keeps your currency stable and predictable for trade and investment. Second, free capital movement allows money to flow in and out of your country without restrictions. This openness encourages investment but also makes your economy more sensitive to global shifts. Third, an independent monetary policy means you can set your own interest rates and control your money supply to manage your economy. Now the problem is trying to do all 3 creates conflicts. If you want a fixed exchange rate and free capital movement, you must give up your ability to set your own interest rates. Why? Because if interest rates differ from the currency you are pegged to, capital will flow in or out, forcing your currency to change value and breaking the peg. To keep the rate fixed, you would have to intervene heavily in currency markets, which limits your monetary policy independence. On the other hand, if you want to keep your interest rates independent and still have a fixed exchange rate, you need to control capital flows. This means imposing restrictions or controls on how money moves across borders. These controls prevent large capital shifts that could destabilize your fixed rate. But if you want free capital movement and independent interest rates, you cannot keep your exchange rate fixed. The currency must be allowed to float to absorb the pressure from capital flows. In real life, countries often choose which 2 goals to prioritize. During the Bretton Woods era, many nations fixed their exchange rates but used capital controls to keep their monetary policies independent. Today, countries with open capital markets often let their exchange rates float to avoid conflicts. This trade-off is why the impossible trinity is called impossible. You can only pick 2 of the 3 objectives at once. So, in essence, the impossible trinity shows that maintaining a fixed exchange rate while allowing free capital movement and keeping control of your monetary policy is not possible. Countries must decide which they value most. This is why some countries face financial crises when they try to do all 3 at once and end up with unstable economies. It's a fundamental rule in international economics that shapes how countries manage their currencies and economies.